G'day, hello everybody. My name is Hudson Worsley, Chair of MECLA, the Materials and Embodied Carbon Leaders Alliance. Welcome to another Spotlight event. Today we're shining a spotlight on mandatory reporting and embodied carbon. If you don't know, well, I hope you do know that regulatory change is afoot and very soon large organisations will have to be reporting on their emissions. But embodied carbon is a little bit trickier than operational carbon. And so we've assembled a fantastic panel of experts to discuss that and to answer your questions on those on the topic. Before we get going, I'd like to acknowledge that I am joining you from Gadigal country on the Eora Nation. Pay my respects to elders past and present, and wherever you are joining from, you are also on Indigenous land. That's something MECLA encourages us all to reflect on. Thank you for joining us. MECLA operates in a pre-competition space. I say that every time, and it's very important because to operate in the public good, that means we don't discuss prices, quantities. It's pre-competition. And that's important because it allows us to have the conversations around the technologies and the processes and the change that's needed to reduce the embodied carbon of the built environment. That's about 40% of emissions in Australia, so we know that that is very important. We seek to bring the emissions a trajectory in line with the Paris Agreement for our sector. So thanks for joining to be part of that. I've mentioned that mandatory reporting is coming. We'll get into standards and some of the real detail. And we have a fantastic lineup of four speakers. Mark Siebentritt, Executive Director of Edge Impact, is joining us. He'll provide an oversight. What are we talking about? What on the horizon is coming? What in the environment is changing? Then we'll open up to a panel discussion, which will include Mark, but also include Darryl Stuckey, Head of Environmental Sustainability at Lendlease. Thank you, Darryl, for joining another MECLA event. Darryl's been a terrific contributor over the years with MECLA. Jessica Richmond is the CEO and co-founder of Sumday, a carbon accounting company, and brings a multi-industry and accounting perspective to this. And then Monique Isenheim, Head of Market Development for Infrastructure Sustainability Council. ISC is also well known to MECLA, so really looking forward to our conversation there. Yeah, it'll be terrific to get into it. So Mark, if I could hand over to you, could you provide us with an introduction to climate-related financial disclosures? What's it all about?
Thanks, Hudson, and thanks to MECLA for having me here. It's a really interesting point in time. We often talk with our team of Edge and with a lot of our clients as well around the significance of this moment. And I reckon probably in everyone's career, there are 2 or 3 moments in time where you reflect and say I was part of something really big and significant. And for me, I think this is one of those moments. We've been building up to mandatory reporting for quite some time, and it is going to have really quite wide-reaching impact. So looking forward to sharing that with everyone who's tuning in today. I'm just going to get myself set up here and share my screen. And Hudson, if you can just help me make sure that it comes up okay. So I'm going to share the screen.
Yep.
So you yep, that's all good. All right, cool. So it's interesting, just another little anecdote. I remember being back about 2010 in a climate change risk and adaptation conference, and people saying, you know, one day there's going to be bankers and insurers and lawyers around the table here. And that seemed like something that was theoretical and maybe would happen one day, where with the arrival of mandatory climate-related financial disclosure reporting, we're well and truly at that day where ESG teams are now working hand in hand with those other disciplines across various range of entities. And I think it's worthwhile kicking this off, just reflecting on where we've coming from, what historically has been the approach around reporting within organisations, and then where we're headed to. And really the history has been summarised in a slide like this, where we've said traditionally we've had financial performance, which has really been reported on through 3 key financial statements. You've got your profit and loss balance sheet, which is made up of assets and liabilities. And then you'll often have information around cash flow statement and a bunch of other financial performance information. And then that's fed into annual reports, and the annual reporting process has got very disciplined, strict timeframes because it feeds into things like annual general meetings. Then separate to that, we had non-financial performance information or metrics, and a lot of that relates to ESG. And for many of us around this call, we know that for quite some time, we've been refining our methods, the information we collect, and how we feed in to those ESG type reports, and ultimately that leads to a sustainability report. But in many ways, in many organisations, those annual reports, which are a bit more financially focused, back to shareholders and out to broader stakeholder groups, they were quite separate to sustainability reports. But that's all really set to change. And you could start to say, what have some of the triggers or the drivers been behind this change? And I'd suggest there's been a number of them, but one of the ones I often point to is a growing recognition at least 10 years ago, and it's really built since then, which has been the recognition that climate change is more than just an environmental or social issue, but that it also has quite significant and profound economic and financial impacts. And there are plenty of sources of information out there around this. One of the ones I've always found interesting, and you can track it every year when the Global Risk Report come out, is that information produced by the World Economic Forum. Now, we went back to, say, 2013, so a bit over 10 years ago. We'll see that there were a couple of climate change-related risks that were coming up in the top risks to the global economy. What we found, though, if we look at the report back in 2023, for example, and this trend's continued, in the next couple of years, despite all the other challenges that the global economy and community faces, climate change is ever present in those risks. But if we look out into the 10-year horizon, well over half the risks are now climate change related. So we've really come from a point where much of the climate change related work that we do was recognised perhaps as more being purely environmental and social issue, whereas now we're at a point where it's clearly understood and recognised that there are also financial and economic impacts. And many of you probably will have already seen this slide. I like it because I think it's one of the neatest summaries going around the link between climate risks and opportunities and financial impacts. And essentially, for those of you who haven't seen it, just a little bit of a high-level introduction here. We've got our transition risks, which relate to the risks, and it can be the opportunities of moving towards a low-carbon economy. So obviously that picks up on elements around embodied carbon. And then separate to that, we've got our physical risks. So that might be things like bushfire or extreme heat or flood. But interestingly, the bottom line and the key message here is that we know those risks and those opportunities, they feed into financial impacts. And ultimately, that means there can be income statement impacts, cash flow and balance sheet impacts. And even just yesterday, we were speaking with Tuesday this week, working with McGrath Nickel and speaking to a group of CFOs and exploring this exact concept of how do these transition and physical risks feed into things like balance sheet impacts and impacts on assets and liabilities. So that connection there becoming stronger and stronger. And so essentially, what does all this add up to? Basically, what's going on is we're seeing the bringing together of those financial and the non-financial performance information into a single report. And importantly, for directors of companies and those companies with reporting obligations under the Corporations Act, those directors are now going to need to be signing off on a single annual report, which will contain a climate statement. Now, that's really quite significant because for those of you who've had work to do either with, you might be part of a C-suite, you might even be yourself directors, but you'd know that directors require, essentially they're signing off on those statements, and there's a certain level of certainty and confidence that they need to be able to sign off on that information. So, from my perspective and what we're seeing coming through the mandatory reporting, this is really a significant step forward in the level of scrutiny and the reliance on the information that we're generating, such as in relation to the way we look at emissions footprinting and covering off on things like embodied carbon. Just a little footnote on this, and I know many people tuning in will be well and truly across this because you've been around this space for a while, but for those who perhaps haven't been as involved with, if we call it a journey around heading towards mandatory reporting, sometimes the discussion at the moment is, wow, this feels like it's happened awfully quickly. This has almost happened overnight. And yet, for those who've been around it for a while, will realise that we've actually been chipping away at this for quite some time. In fact, it's nearly been over 2 decades of work across what we'd suggest have been voluntary standards. So building up from GRI, and then with TCFD coming in about a bit under 10 years ago, then eventually with the International Sustainability Standard Board standards, and then moving up in this period now where we're headed towards mandatory climate reporting. So while for some who are perhaps getting a little bit used to the idea of mandatory reporting, it might feel like it's happened all very quickly, I'd suggest we've really been building up to this for quite some time, and the writing's been on the wall for a while now. So perhaps onto the more pointy bit, what does it all mean for organisations, those organisations who are going to be reporting here in Australia? And I'll touch on who's reporting in a moment. But just at a top level is to say that we've had legislation that passed through the Australian Parliament in September, and the reporting requirements officially kick off as of 1 January next year. Now, importantly, depending on what organisation you're involved with and the timing of financial year will influence exactly which of your financial reports need to address this first, and we'll come to that. But officially, the initiative kicks off as of 1 January next year. We've got 2 standards. The first one, which is called S1, so the AASB is the Australian Accounting Standards Board, and S1 is standard number 1. Standard number 1 is a voluntary standard. So we would expect to see those organisations who perhaps have been leaders around taking action on whether it's climate change or sustainability or ESG in general. We might expect to see some of those continue on with their voluntary standard. But perhaps what's capturing the most attention right at the moment is the mandatory climate disclosures. And so that requirement to have mandatory reporting, and particularly picking up on key themes related to governance, risk, strategy, and metrics and targets. Another little footnote before I just move on to talk about what type of entities are covered by the mandatory reporting. It's also worth noting that this is not just something which is impacting corporate Australia. In fact, I'm sure there'll be many people listening who are working in the public sector as well, and they'll be well aware that, for example, within the Commonwealth, there are Commonwealth climate disclosure requirements that are coming through. And in fact, in New South Wales, about the top or the largest 30 New South Wales state agencies are also going through, will enter into a period of climate-related disclosures. And importantly, they'll actually need to do their first reports on this current financial year. So the key point here is that this is not just something which is for corporates, it's also relevant to Commonwealth agencies and also New South Wales state agencies. In terms of who will get picked up by this, there are 3 groups. And if you're working in a larger business and you're not aware which group you're in at the moment, I strongly encourage you to either have a chat with teams in your organisation who might already be working on this, or start to do some of your own investigations, because the group that you're in has a big impact on when you need to do your first reporting by. And you'll see the category there. Basically, they relate to consolidated revenue, consolidated assets, and employees. And it's estimated that there are about 500 Group 1 companies in Australia, 500 Group 2 companies, and 5,000 Group 3 companies. So all up, 6,000 of the largest entities, businesses in Australia will become part of the mandatory reporting requirements. And importantly, this covers both those that are listed companies and also privately held companies. So it applies to both. Now, the time at which you need to first meet some of those reporting requirements does depend on your financial year. So, for example, if you're a July to June financial year reporting entity, that means that if the legislation kicks into gear as it applies to your organisation as of 1 January next year, what that will mean is that the first reports that you submit will be against your FY26 performance. So effectively, it'll be in that report that comes through in, let's say, the August, September, October reporting season in 2026. And then if you're Group 2 and Group 3, they start at slightly different times. So you might be thinking, what are the key components of compliance? What will I absolutely have to do? Well, they're there are some governance measures that are required. Now, often these types of governance measures will already be in place, particularly for organisations that are well versed and have been looking at for ESG for quite some time. But a big component of it, and I'd suggest one of the top two areas that's discussed, is around emissions footprinting, particularly Scope 3. And I was earlier this year at the OECD Climate Governance Forum, and this was getting discussed extensively there. And one of the top two issues that was getting discussed around areas of complexity and organisations working their way through, one of them was Scope 3 emissions. Interestingly, the other was climate scenarios analysis, which is on the second or the third bullet point there. Another component of compliance is around transition plans, which is really a vehicle or a way of communicating to whether it's shareholders or stakeholders, the plans on, say, moving towards a low carbon economy, or how you're addressing physical risks. And then last of all, are climate-related metrics and targets. Now, I don't want to take up too much more time here, but just a little note is that assurance is required across these different components. They are limited assurance for some of those components in the first year. That then moves for reasonable assurance for Scope 1 and 2 in the second year, and then essentially assurance builds up over time. And essentially by the time we get to 2030, we'll see all of Group 1, Group 2 and Group 3 will all essentially be reporting on the same components to the same level of assurance. So that'll occur and roll out over the next couple of years. Just before I wrap up, a couple of interesting notes that came out of the OECD Climate Governance Forum in terms of mandatory reporting. This was held in late August. A lot of the messages there, and this includes from the likes of the chair of Coles, messages along the lines of don't let the perfect be the enemy of the good. There's clearly some concern as to how do we get our mandatory report perfectly right. The reality is that you've got time to build up to it, but also that there's an opportunity to start with a dry run. So a dry run meaning starting to put together some of your first disclosures, perhaps even advance of exactly when there's required, because it gives you a chance to look at, do you have all the data and systems in place? You can generate that information. I won't go through everything on this slide, but the only other one I did want to flag is around data governance and systems. When briefing in boards about the mandatory reporting requirements, one of the most often asked questions from directors is, do we have confidence in our underlying data governance and systems? And the reason why this is important to directors, and I flagged this earlier on, is that they are personally signing off as directors. They have a fiduciary responsibility. They're personally signing off on those climate statements. And so they want to have confidence in the data that underpins those disclosure statements. And one final little comment before I go off screen again is just to note around where disclosure sits. In many regards, we see it as really just the tip of the iceberg. And there's going to be in the next few years a lot of focus on the disclosure and exactly what you say in the disclosure, but we really see that as being the tip of the iceberg. And really what's happening below the waterline, if you'd like to use that analogy, is there's all the things you do in terms of pulling the information together, understanding what your risks and your opportunities are. And then as well as that, outside of the mandatory and compliance side of this, is what are the broader benefits you receive for business strategy. So very much reflecting that while there are some significant disclosure requirements coming through, and they'll obviously spark a lot of discussion around how that's met, whether it's in the contribution of embodied carbon or other aspects of reporting. We also want to look beyond the mandatory and into the broader benefits that an organisation receives for its general strategy. So I will, Hudson, I'll leave it there and happy to hand back to you and join in the discussion later on.
Fantastic. Thank you, Mark. That's a terrific introduction. I remember the Paul Keating slight on one of his rivals when he said they were all tip and no iceberg. I think there's a lot more iceberg than tip on this one. So stand by. I'm going to do a shameless plug now because MECLA is seeking to set up a working group for the investment part of the property sector and really looking at embodied carbon reporting, property investment. And yeah, these are the 5 areas of interest: scope of disclosure requirements. And anybody working in this area knows that defining the boundaries and getting the scope right is so important to accurate Scope 3, all emission reporting, but particularly Scope 3 because it's complex. Helping identify the stages in a phased implementation, mandatory content and emission scope, assurance and liability, that point that Mark was just making about directors and their liability, and then a focus on standards and alignment, noting that it has been a 20-year journey to get here. It's a global movement, and Australian standards have definitely referenced international standards, but there's data alignment behind all of that. There's a lot of work. We would love to see people with a finance and embodied carbon and property and investment hats diving into a MECLA working group. So please get in touch if you are interested in that. I think there's room for MECLA to contribute to this and to help our sector make the most of the bit of the iceberg you can't see, the opportunity. All right. I'd now like to bring our other panelists into the conversation. Have we got Darryl, Jessica, and Monique on standby? Fantastic. Darryl, can I start with you? I mentioned in the introduction you've been around the MECLA space for quite some time. What does mandatory reporting mean for the head of environmental sustainability at Lendlease? ASR, what does that disclosure mean for you and for your company?
Yeah, I think certainly for Lendlease, we have been on that journey for a little while. So fortunately, we had a very supportive board that actually signed us up to commit to the Task Force on Climate-Related Financial Disclosures. And that kicked off a process of disclosure or voluntary disclosure back in sort of 2020 for us. Obviously, now with the emergence of mandatory disclosure, ASRS, that puts an additional, driver behind that, and I guess for us in particular, an evolution in terms of what we've done to date. So I think it's fair to say, I guess, a lot of the voluntary reporting has been a little bit tentative because we have been acting voluntarily, and therefore, the impetus to disclose too much and more maybe than what some of your competitors are that aren't voluntarily disclosing that information has, meant that we probably pulled back a little bit and kept a lot of the stuff under the surface bubbling away in readiness for this mandatory phase, I guess. But for us, it's about really getting the metrics solidified in the business and embedded within our finance and accounting. I guess we've also got the fortunate position of preparing an integrated report. So sustainability and financial accounts are already kind of reported in a single place. But again, it's about making sure that we're working hand in glove with our finance team so that they're properly empowered to do their part, and we're really embedding it in the business. I guess the other thing that's interesting for us too is we're actually captured at a number of different levels throughout the business. So we've got some funds under management that are captured and therefore have different materiality thresholds for reporting and disclosure, and will have to lodge their own separate disclosures in addition to our sort of corporate headstock level report. And we're also captured internationally under some of the other legislation, in Europe, Americas, and Asia as well, for that matter. So whilst there's some similarity and some sort of synergies and alignment with the international standards, there are some sort of differences between all of those two that we need to sort of manage and try and harmonise to I guess, leverage and get the most efficiency out of the process for us.
Fantastic. All right, thank you. You're not off the hook. Stay on the line because I've got plenty of questions more for you, Darryl. I'm really keen to understand how you went about setting boundaries, but let's come back to that. Jessica, Richmond, I met you only recently and you were presenting on a similar theme, also with Edge Environment, but it was also with the Australian Retailers Association. I was particularly interested because you weren't talking construction, infrastructure, building, and I thought, hang on, there've got to be transferable lessons from another sector. Could you introduce yourself, your business, and your take on this discussion, please?
Yeah, thanks, Hudson. So my background is a little varied. I started in energy and resources law and then moved into commercial management in mining. So I was in iron ore for a while, and we really started working on some of these decarbonisation projects essentially, and realising what I'm sure many of you are now, that it is actually quite difficult to demonstrate carbon return on investment. And the way we run those numbers, it wasn't clear. And this was a few years ago, and we certainly hadn't embedded these concepts of carbon accounting and having baselines. And yet we were trying to look at these potential risks and convince a board that we needed capital allocated to these projects in the event that customers changed their requirements on wanting low carbon commodities, all of the things that we're discussing now. And so through that experience, we essentially started to see that peers in our space, mining, manufacturing, heavy industry, were all grappling with this. And so my co-founder and I, we started an accounting firm where by stealth, we essentially wanted to be doing the normal accounting and modeling that we had been doing for quite some time, and incorporate sustainability into that as a process, which we did for quite a few years, and started doing more and more on the carbon accounting side, and started to realize that, to be honest, I think everyone understands globally the way carbon accounting is being done is based on very high level averages. 90% of footprints are sitting in scope 3. Most of us haven't touched that, let alone got accurate data from suppliers. And yet you could predict that standards would come in. So what would have to change? And I think we expected that some of the robustness and transparency and processes would come in, which they obviously have, which we've just been through. And then our view on that as an accounting firm was, well, where is the accounting software that allows us to do all of these normal things in a financial world? Where is that level of granularity and robustness that will translate into the non-financial world that is fit for your finance teams as much as your ESG teams? And that really led us to accidentally becoming a software company. And now that's exactly what Sumday does. We work with organizations that are really trying to streamline this as a normal business as usual process, often getting finance teams involved, and really getting ready for this next era, I think, of what non-financial reporting is going to be.
Just like that. Thanks, Jessica. Yeah, look, that's fascinating. And I particularly like that it's taking the granularity and getting what sustainability professionals have been doing for a long time, but making it business as usual and putting it into terms that core business decision makers can understand. Isn't that what success looks like when sustainability becomes a core business metric? Imagine that. Hey, Monique, if I could turn to you. So yours is Infrastructure Sustainability Council. I think everybody on the call, all 200 people, which is fantastic, will know about ISC. But as a membership organisation, what are you hearing across the infrastructure sector when it comes to mandatory reporting, being prepared, being unaware? Where are things at, and what are you hearing?
Yeah, look, I think Mark has gotten a really good introduction about where the challenges are. I think data is a huge topic for everyone. And I think, especially around climate, probably the infrastructure sector is in a relatively good position compared to maybe some other sectors, because they've got a long history in reporting and collecting data on their sustainability performance, whether they have shared them previously or not. It sounds from many of our members that they feel like they've got at least made the first steps into getting ready for those reporting requirements. Obviously, when it comes to looking at the whole ecosystem, working with suppliers and getting all the data from third parties, that's something where, especially when you're working with not tier 1 suppliers, but the smaller ones, in the future, when you've got to report more broadly, there's going to be some challenges, and that'll be interesting to see how the sector can then work with suppliers to uncover all those data and make sure they have what they need to respond to the requirements. Yeah.
Okay. I might come back to you now, Darryl, because one of the questions I've got, I'm also a consultant. When I'm not wearing a precinct hat, a MECLA hat, I wear my precinct hat. We're working with a client, terrific people, a water services provider. Their clients will be in the first group to report. These guys will be in the second group, but one of their major suppliers doesn't have the data, doesn't have the information needed for them to report. So they're starting to get their ducks in a row because they know their clients will need it. And we start looking at the value chain side of things. How has an organization of your size with the number of divisions, how have you started to look at supply chain issues when it comes to data?
Yeah, look, that's a very topical conversation, live conversation. One thing we've started as a business, I guess, we've approached Scope 3 slightly differently in the terms that we've actually set some ambitious targets around Scope 3. So absolute zero, Scope 1, 2, and 3 by 2040. That's a sort of moonshot, flag on a hill target. But what that does is it starts to bring into, I guess, focus the fact that we really need to be clear on what's within that measurement boundary. So the greenhouse gas reporting protocol Scope 3 guidance provides 15 different categories that they recommend you should look at and consider based on your type of business. We started with that. We reviewed a whole bunch of other standards as well. We ran the ruler over our emissions, did a bit of a sort of hotspot analysis, if you like. And then consulted quite broadly internally as well and developed our own Scope 3 protocol, which outlines for us what's within our reportable boundary. And so off the back of that, we've also now been disclosing our Scope 3 data for past 4 years now. And we're progressively looking at how do we start to take, obviously there's aspects of that are still estimates, or we're using proxy values. But over time, we recognise we need to start to bring that into sort of live data. So whilst we've got a lot of a solution around many of the data gaps, particularly downstream for us, a lot of that is, tenancy data from assets under management. So that we have obviously plans to close some of the gaps that we have in that space. But speaking specifically around the, MECLA and embodied carbon, a big chunk of our emissions sit within that supply chain. So we've been for some time obviously advocating that our suppliers invest in conducting life cycle assessment, conducting and disclosing via EPDs. So environmental product declarations for us are really kind of key and important part of that. And we've used our own analysis that we've done now for a range of projects. We've done life cycle assessment on, and we've actually established benchmark rates. So effectively, an embodied carbon emission per hour worked for a different typology of project in a different region in which we operate. So we have those benchmark rates, and we apply those, and we track with quite a high degree of resolution the number of hours that we're working on our construction sites. We use those metrics for a range of other things around lost time injury frequency rate reporting, tracking, how many people we've got on and off site at any particular time from a, accountability and safety position. So, using that data, and then the next phase for us is really about how we now start to set up with some key strategic partners in our supply chain, some direct data exchange. So how do we then get, a regular push of data from their system to our system, which basically discloses, this is the volume or quantity of the product type, the associated EPD or proxy embodied carbon value where we may not have an EPD at this stage. And we can start to shift some of our benchmark estimation into sort of real live feed data. And we progressively nibble away at that until we've got a complete account and record across our supply chain. So that's the vision, Hudson, and that's what we're working towards. I think one thing that would be great, and it's fantastic, obviously Jessica's platform and system we think there's a big opportunity for someone to sort of step in and help to establish some sort of data exchange taxonomies, protocols that everybody can agree across the industry, to facilitate and streamline reporting. Because I think the danger, particularly with Scope 3, is it's very easy to go down a deep hole and not come out for some time. So how do we streamline the actual reporting effort so that we're not then taking resources away from the job of actually driving the emission reductions that we sorely need?
Oh, and that's what it's all about. Yes. Yeah. Good touchstone. Yeah. I mean, the risk of incredible detail but no accuracy is really there. Mark, I saw your hand go up, and I'm keen to hear your perspective. You know, what happens when the supply chain doesn't have good data? But I think you wanted to comment on something. So over to you.
Oh, it's linked to the supply chain, and I think just a recognition that day is now in terms of the request for more data going back through the supply chain. So Darryl and I were both at an event recently, a workshop where the director of one of Australia's largest companies was very transparent in saying that they are pushing the requests back through their supply chain. So essentially, if you want to supply this organisation with services, you will just need to provide the data. So it's very rapidly becoming a ticket to play. I think that's not just in the corporate world, that will also be in government world as well. So if you have government agencies needing to do mandatory reporting and they have the same requirements, someone's going to have to sign off on what they're disclosing. They're going to want confidence in the underlying data. So they will be pushing that request out through their supply chain, and it'll become part of procurement. I think what this means in the context of mandatory reporting, though, Hudson, is really quite interesting, because on the face of it, you might look at some of those slides that I shared before and say, well, look, really, it's only Group 1 who needs to get cracking straight away. So, the likes of Darryl just needs to get busy. The reality is that for Group 2 and Group 3 entities who are part of supply chains of Group 1s, many of them have realised they need to get into it now. And so what we're hearing already is a lot of Group 2 and Group 3 entities who perhaps don't technically need to do their reporting immediately, they're already starting to make progress. We're already, on top of that, hearing organisations who don't actually have mandatory reporting requirements at all, who don't meet the threshold for Group 3, realising that if they want to be a preferred provider to those companies who do report, they're going to need to do it as well. So I think the impact on supply chain is really significant, and the need to provide data, and we suspect that's going to move pretty quickly.
You think I noticed one of the comments in the Q&A saying some entities don't want to share data for privacy reasons. Is that a valid argument? Is that defensible? Well,
if I look at what you need to disclose, so the disclosures will be about the impacts on individual businesses, and are they financially material? Ultimately, that's what it's about. Now, if there is exchange of data within organisations, it may not necessarily mean that data is going to end up in a public-facing report. But if you're delivering services for another business, they're going to want to have enough confidence in your information so they can do their reporting. And so I think it's going to get interesting. So if a company says we need more data, if we're going to continue to work with you, we need more data from you, there's going to be some very interesting conversations had.
I think there are parallels there to the modern slavery questions to say, well, look, if you want to deal with us, we want to make sure it's clean up the line. Hey, Monique, can I ask you, Darryl touched on the reason we're doing this is to reduce emissions. We're not doing this just for compliance or just to keep accountants in business. No offense, Jessica. But what's the advantage? What do your members see as the opportunity here?
Yeah, look, if you look at where the requirements come from, they come from, I guess, the investor's perspective, right? And they want to hedge the risks, and so it is a compliance. It's mostly about compliance if you just look at the reporting. But hopefully, for most of us who are on this call, and a lot of our members who are members because they want to have move the boundaries as towards business as usual and achieve sustainable outcomes across climate, but also social and other environmental factors. The opportunity here is really that because of the increased level of transparency, that makes companies more comparable across those different dimensions. So it's not just the financial focus. And the opportunity is for those that are already leading in sustainability, that is really something that they can show, and that puts them in to an advantage, as opposed to sometimes it is perceived as a disadvantage because, you know, there are cost implications for certain sustainability measures for carbon reduction and so on. And so the opportunity here really for those who are already progressive is they can be ahead of the game, they can show it, and there's possibly better access to finance, and also, I guess, from a broader stakeholder perspective, a lot of the customers of our members are governments. So this will be creating an extra level of transparency of who the government deals with and who they give their tenders to. And then even the broader stakeholder community, NGOs, and so on, will have an interest in those data. And the better you are already positioned in that space, I guess the less heat you will bear, and the more, the better you're prepared when that happens.
That makes sense. Thank you, Monique. Jessica, can I ask you, obviously you've identified a business opportunity, a need, a market need, but from a technology point of view, what role has technology got to play in this? And could you also talk to Darryl's point about multiple standards? And, you know, is there a coalescing of thinking around standards?
Yeah, it's something that we're really passionate about. I think, as a few people have acknowledged, the majority of emissions sit in scope 3, and the way that we currently account for those emissions is based on generally using spend or quantity data if we have it, and then multiplying it by industry average emission factors. And that's kind of useful for hotspot land where you say, oh, should we use concrete or should we use timber? But it becomes increasingly unhelpful when you're trying to work out, well, which supplier should I get the concrete or the timber from once I've made that decision? And nothing really becomes overly actionable, and nor can you credibly remotely track progress to net zero unless that data is coming in. And so then you have to say, well, how on earth do we get supply chains that are largely made up of SMBs in this country and globally? How do we make it so that we can ask the right questions? And the right questions are not, do you have a net zero target? The right questions are, have you done a cradle to grave assessment on the goods or services that I've purchased from you? And do you have a basis of preparation for that? And how do you make responding to that totally normal? Just like a local cafe does their tax return, so does Rio Tinto. They go to somebody that they can afford to, a bookkeeper and goodness knows who from the big four, charging goodness knows what, but we do it. We do it in compliance with standards. And so what you're starting to see here, thankfully, is some global cohesion around the accounting standards that you should be doing it to. So everyone, in my view, should just be doing it largely to the GHG protocol. ISSB, Australian Accounting Standard Boards, when it comes to carbon accounting, essentially everyone is saying, do it in line with this protocol. There's a bit of grey in that. This protocol sat on a dusty shelf for probably 15 years, and now suddenly it's compliance in accounting standards globally. I'm sure they're all having a little bit of a heart attack, and we are seeing investment into that to kind of remove some of that grey, and there's a lot of consultation happening on that now. So in some ways, it's quite a good time because you've got the accounting standard, and now you're saying to SMBs, I need this type of data. And if I don't get this from you, I have to rely on an average. And so does this become a ticket to play? Does it become part of procurement requirements and contractual requirements and tenders? What I'm seeing in the market at the moment is actually just quite a lot of empathy for those SMBs where people are hesitant to go and put it in the contract tomorrow to say, you must provide me this data. Because they know family-owned Joe and Sons that's been providing gravel for the last 20 years has no idea what scope 2 means, let alone anything else. So this is something we're really passionate about. We're working a lot with Xero, the accounting platform. We've got 4.5 million users nearly on there that are all SMBs. Around 70% of the data that you might need for carbon accounting is sitting in there. So how do you make it so normal to do this kind of accounting? Have your disclosures, have your gaps, that's fine, but make it also so seamless to distribute that data, just as we would financials if we were getting a business loan or anything else. I don't actually think it's as insanely complicated as it's often made to be, because in many cases, companies haven't even asked the question in the first place. What I'm seeing from SMBs is actually an appreciation of when a big company comes out and says, we have this target. This is the type of data I need from you. You've got 12 months. Here's access to some education, support, subsidy, whatever it is that you need to move the needle on this. And then let's revisit where we are, because without that conversation happening and being super transparent upfront, the elephant in the room is that there is no net zero in scope 3.
Bloody elephants, they're difficult, aren't they? Hey, Darryl, from a Lendlease point of view, you've got thousands of suppliers, and one of the questions in the chat was, well, how are you supporting some of them for that exact point that says, well, you know, I've been providing materials to your site from my quarry, and, you know, I'm still using paper invoices. How the hell do I do scope 3? What's scope 3? How do you, you know, educate them, help with awareness?
Yeah, various approaches to that. There's not really a one size fits all for us. I guess our approach to date, very much being respectful of some of the issues that Jessica raised, is to target some of our larger suppliers, which quite frankly are also typically the suppliers which are representing the larger proportion of emissions. So, you know, generally large multinational firms, some that are actually quite a lot larger than Lendlease. So they're sort of the first cab off the rank. And, you know, generally they're already well on the journey around environmental product declarations and disclosure. And it's more a case of how we work together to streamline that connection of data and get the right rhythm around all of that. For some of our smaller suppliers, where we've had some success is when we're tendering particular service. So if I actually speak to some experience on Barangaroo, we had a access floor provider. So an access floor is effectively a pedestal with the final finished floor that sits in office and allows you to run all your services underneath the floor. There's around 50 football fields of access floor across the 3 towers at Barangaroo, so it's not an insignificant amount of material. But that was actually a small business that we worked with. So whilst it was a small locally owned, family-owned business that designed the floor, but then outsourced the manufacturing to a Chinese manufacturing partner, and then was larger than responsible for the sort of warehousing distribution of that product. And we, in our tender, said, look, we'd be open to anybody who can provide the access floor that meets all these other specification requirements, but also if they're willing to have a look at preparing an environmental product declaration and even certifying the product as carbon neutral. And so, you know, our successful partner at the time signed up and said, yep, we'll do both. We'll get an EPD, we'll do the life cycle assessment and the work, and we'll get the certification. Not really knowing. It's fair to say that we had actually run a number ahead of them and knew kind of what the size of the liability was that they were up for before they even knew. But to their credit, they worked with us. There was a lot of collaboration around selecting a consultant, helping to scope that consultant to support them in that journey. They found some efficiencies in the process. They actually changed their product in response to that as well, to get some efficiencies and reduce the embodied carbon in the product before they took the step to offset. So a number of great outcomes. And at the end of it, they had, you know, a bunch of collateral and marketing material. They were ahead of the curve in selling access floor, you know, to other building partners and people asking for that product.
Okay, great. So leadership has its advantages, and there is material, material benefit, not just an carbon accounting benefit. Hey, Mark, can I turn to you? Something that many of us will be aware of is the risk of greenwash. How are you looking at that risk and advising clients, and in general conversation, how do we make sure it doesn't happen? How do we call it out if we see it?
You were an interesting point around that, Hudson. I feel like the presence of that and awareness of that has really gone through the roof. And also, particularly with some of the people tuned in might have heard about the impact on Vanguard recently, where they were called out for greenwashing, and that actually voluntarily reported, and they still got stung with a fine. So Definitely a lot of interest in that. What we're seeing is most organisations we're working with, and just generally across industries we're engaged with, are very focused on the bare minimum compliance. So I almost feel like we're going to see a very strong focus on how to just make sure that entities can meet the requirements of compliance. And then at some starts, they'll look at how do they get out more on the front foot again in the future and position themselves around ESG or doing well around sustainability. So I think there's a lot of awareness around greenwashing and probably a bit of a stepping back from sort of a lot of market positioning in relation to ESG, and more around just knuckling down to get the basics covered. And part of that is probably reflected by much of this work now is moving into finance teams. So we're seeing that it's interesting even we're a consultant, we see more and more tenders now more than ever before come out from the CFO. They used to be from the CSO or the Chief Sustainability Officer or ESG teams. They're now coming out from finance teams. So I think that's just a general indication that the way that this is getting done and who's signing off on the reports has fundamentally changed. And my take is that happened very, very quickly. It was probably over a period of about 6 months, and by the time that legislation came through and was passed through Parliament, it all happened very quickly. So still a lot of strong interest in greenwashing, but I think as we see that push towards compliance is almost reducing the risk of it happening, at least in the short term.
Great. Hey, while I've got you, can I ask, in your introduction, you mentioned Commonwealth government entities and New South Wales state government entities. One of the questions that's been voted up in the Q&A, and I'd encourage our participants, our viewers, if you're asking questions or looking at others' questions, please do vote, because that helps me triage what we put to the panel. But one of the most popular questions is around local government entities. If they're in Group 1 or Tier 1 on metrics and NGAs, but are they excluded currently on this mandatory reporting?
They are. Interestingly, so I wear a couple of hats. I'm also a councillor with the council. And I know through wearing that hat that the Australian Local Government Association recently had a motion go up before it, looking into the mandatory reporting requirements for local governments, because they don't exist. Interesting thing about local government for me, it's an area I'm quite passionate about. I think probably for 20 years, in many ways, local government was well ahead on the curve in terms of taking action around climate change, both around climate resilience and physical risk, and also looking at carbon. So they've done a huge mountain of work. They've often been the ones who already had their climate reports up in front of the internal audit risk committees for many years, but they're at a position where they don't currently have mandatory requirements. It's a little bit complex in the sense that councils are really an artefact or a product of state government legislation. And so to have Australian-wide mandatory reporting requirements for councils is going to require some sort of coordination across states. I would think that it's just inevitable that that's going to come through. It will be complex to navigate, but councils are already really well positioned, because if I look at what the requirements are, a lot of councils would already well and truly meet a lot of the requirements. Sure, like everyone, there'll still be work to be done, but they're very well advanced. It'd be often, particularly metropolitan areas and outside of large regionals, there'd be very few councils who haven't already done some of the work that's required. So, not in place currently. My personal view is it's absolutely needed, and I think we'll see that take shape in the next sort of, at least more discussion on that in the next 12 to 18 months. Just while I've got the floor there, Hudson, one of the things I was just going to flag as well, which I think is interesting, I'd love to hear thoughts of some of the other panelists on this as well, as the time frame implication of all this. So, we're coming from a world where in the past, if it just took longer to get your Scope 3 work done, well, that was okay, because the sustainability reporting timeframes were probably perhaps a little bit looser, depending which organisation you're in. They might have been a little bit looser, so you had a bit more leniency with getting that data together. Whereas we're moving to a timeline now when we're going to have the governance people within large businesses, the CFOs are going to be saying, this is the date, and that date doesn't move. And perhaps the absence of data, I don't think that there'll be much leniency around that. The reality is that that information, the reports, the results will be due by a certain time. So in terms of the challenges moving forward, my sense is that meeting the very strict timeframes around annual corporate reporting could be quite a good, could be quite a large challenge. But I'd be interested in whether, others on the panel agree with that as well, Hudson.
What do you think?
Yeah, agree that is a challenge, a current challenge for us, having an integrated report. So there is a time lag around our data. So we typically operate a quarter in arrears. But we're reporting monthly. But yeah, there is that time lag still. The way we typically deal with that is we get audit and assurance over the lion's share of our data. We estimate any gaps for the full year and provide a forecast. And we have that process documented in our base of prep and assured. And then our disclosure in our annual report is linked to that kind of assurance. And then post August, we then release an ESG data book. And that is on the full year. We then get that assured for the full year, because we then got that final quarter in. And then obviously if there was to be any, major discrepancy that was picked up, it's material, that would obviously trigger a restatement within our annual report. But generally we're pretty good, because the gap that we need to close isn't too big, and we're reasonably good at forecasting and plugging that gap, and being a little bit conservative in the process as well. Yeah.
Jessica, one of the questions that was asked to us when people registered was from an HVAC, so heating, ventilation, air conditioning equipment and services company. And they said, and I imagine they're not huge, but I imagine their clients probably could be as huge as Lendlease. Mm-hmm. How would they go about capturing information that their customers want, but making sure that it's valid, and they're a small organisation? Mm-hmm. How would they go about it? What do you say?
Yeah, it's a good question. So I think particularly at the SMB, and I think in this space there's a lot of talk around like the EPDs being one piece, and I think it's important to kind of separate these two concepts. So yes, there is like that world, but really for SMBs that are coming in as suppliers in the supply chain, you don't necessarily need those organizations to provide an EPD to get a reliable emissions factor for the goods or services that you've purchased. And I think it creates a little bit of concern, because to do full LCA or to do that is this big investment with consultants. It's point in time. You go and change something next year. It's off already. Is that realistically what we need when you move into like a mandatory reporting world? Essentially, you're going to have customers or suppliers starting to say, customers starting to say, oh, I want to replace the eco-invent emissions factor I otherwise have to use for you. So what's the minimum I need to do that? It is not necessarily go and do that whole piece. For someone like the HVAC company, they might literally start by doing their organizational emissions on a cradle to gate basis. So they might say, we do our scope 1, our scope 2, our scope 3. We will use the spend data where we need to use it. We'll also look at our activity data where we can do it, and we'll use the emissions factors that are publicly available to go about that. I hope that the world we're entering into, their existing accountant could assist them to do that at a very reasonable fee, and they prepare their basis of preparation report. It's essentially a management accounting exercise then to say, here are our overall emissions for this organisation, and this is how we allocate them to the goods or services we sell. So here you go, big customer. Here is the emissions factor I think you can rely on. Then what's starting to happen is that those big companies are saying, well, can I rely on that? Or is that not worth the paper it's written on? And that's where, making sure you're really clear and talking to your auditors to say, well, what will be a reasonable basis for us to use that over eco-invent? Let's make sure that they understand that, so they're not doing a heap of work that means, oh, great, we ticked like a green box, but it actually has absolutely no impact on our own scope 3 reporting. So I think just being super practical, and if you are that, and then you're allowing the SMB supplier to provide that information and not necessarily having to go and do some enormous consulting exercise, then for the purposes of the accounting and the disclosures and the reporting, I actually think that's best practice. I actually think that's the way that we will be headed.
Okay, interesting. So if that HVAC company and this is hypothetical, of course, but if a lot of their kit is coming manufactured from overseas, so they'll be addressing carbon reporting standards from somewhere else, wanting to report them here perhaps, and then if Europe has a carbon border adjustment mechanism, we're looking at a CBAM here. How is that going to play in this? Is that going to interfere or is that going to help?
Well, essentially the underlying piece on all of that from the accounting perspective of what I need to show is still a GHG protocol exercise largely to have that information available. I think some of, depending like, what does our CBAM become, or particularly for this industry, and I don't pretend to be an expert in this space, so I'm well aware that requirements around those different ways of providing that data for EDPs or however it is done. There is a way that is being done at the moment, but what I think will happen once you start globally having this requirement to distribute primary emission factors, and that they need to be done on a cradle to gate basis, you have to ask, is that going to be done on companies doing point in time life cycle assessments on every single thing to satisfy 3 or 4 different frameworks globally? No, I do not think that will happen. I think they will literally change frameworks and policies if that is otherwise there, because it won't happen. You will not find an SMB unless you say, oh, you're going to have a financial penalty, or if their customers start saying, I will not buy from you unless you have this. And then they will kick off and say, well, it's 50 grand for me to give you this. It's point in time and it's wrong next year. Well, I'll go, oh yeah, that seems insane. So how do we actually do this? It's actually a management accounting exercise. And I think that we will come to understand that. Allocating costs now, so you know dollar per ton of ore, that's a very common piece. The way you work out how much we're going to charge per ton of whatever we're selling, it's a common process around financial cost accounting. I think we need to pick up those same principles and pull it into carbon accounting. And once we have that and that reasonable basis, I think that will become very much relied upon. You also have to consider what are you replacing? So you might say, well, I don't have a full EDP, I don't have a full life cycle assessment, but I have the SMB's full organizational emissions allocated to the goods or services I'm buying on a reasonable basis that might have been prepared by their small business accountant. Is that better than EcoInvent's 2019 plus CPI EF that I would otherwise use? I think that's going to be very interesting how companies start to consider that. And that's a topic that people are talking about right now. We talk with a lot of the Big Four auditors on this topic right now. For the accounting nerds of Sumday, this is a very exciting conversation to be having, because it starts to get you into a more democratized, normal, transferable world where what Lendlease needs is the same as what someone in Europe needs, is the same as what their insurer needs, and is the same as what CBA needs. That has to happen, and I think that will happen.
Fantastic. Thanks, Jessica. Monique, the infrastructure space has a lot of international players, big contractors. How have you spoken to any of your members around, lessons they've learned where, standards may be a little bit early adopted than ours? What are they saying about the journey Australia is on?
And interestingly, the Kiwis are a little bit ahead of us as well. No particular examples that I can think of, but we can certainly see that those companies that work internationally tend to be the ones that are more progressed. So, for example, if you look at the, so some of the companies that work globally are at the forefront of voluntary reporting as well. For example, already trialing TNFD for next year, and so on. No specific examples that come to mind, but
okay.
I've mentioned.
Yeah. While I've got you, I kind of joked when Darryl mentioned the the impact of all of this around emission reduction. And look, that's why we set MECLA up, was to drive down construction emissions, particularly embodied carbon. How do you see members? So the ISK rating tools are all performance-based. They're about doing better than the benchmark. Do you see this as, you know, seamlessly building into that, or is it just another layer of reporting?
Yeah, look, we've just recently actually looked at sort of going one step further and looking at TNFD, which is basically the CFD on steroids, because it looks at all of nature, including carbon. And the topic around data becomes even more prevalent in TNFD, because when you build something, it happens in a specific environment, and so understanding your place-based impact is really important. And when you do an IS rating for infrastructure, or an equivalent rating for other buildings, then you really do this reporting and the data collection on an asset level. And so doing the ratings really helps to get the data, and not just industry average data, but actual project related data, and report against actual projects, not just some estimates, and say exactly what the impact of those projects is. And that can start with climate, but if TNFD goes down the same trajectory as TCFD, and it's probably not going to take another 9 years, then the level of reporting will only get broader. And then knowing that you've got the systems in place and possibly get third party verification as well for those is going to really help. And this is where the sector is maybe more prepared than some of the other sectors, because they're already doing these things.
Can I quick question to you, Jessica? So TNFD, Task Force for Nature-Related Financial Disclosures, you've set up a business to help and to harness the opportunity that's come about because of carbon reporting becoming mainstream. Do you anticipate, are you hearing discussions that nature-based reporting is following a similar, and as Monique said, hopefully an accelerated path?
Yeah, it's a really interesting space. We sort of at the very start of Sumday said, we swim very firmly in our lane of the stuff we know, which is the accounting side. And so for us, we're really waiting for a signal or a trigger that we had in carbon. I think non-financial accounting, you have to really, believe or hope that starts to become the lens by which companies are valued and the way we all do business. And so carbon accounting is one aspect, social impact accounting, natural capital accounting. Our vision is being a home to all of that non-financial accounting that drives companies. But as a company whose entire DNA are lawyers, auditors, and accountants, a very fun bunch, there is a very low appetite to be a software company trying to define, what the standard should be or what normal should look like. So we're essentially waiting to see, a bit of the follow the money. If you sort of see the banks starting to say, well, yep, we're taking this into account before we lend, or yep, we know that AASB has already indicated that they're going to be looking at this, maybe post the first consultation or post an understanding of what international framework they might be looking to adopt to have a bit more of a typical standard of this approach. That's probably something that becomes our jumping in point. But I would say it's, I think, surprised the entire accounting profession how quickly that from an accounting standards perspective, carbon came through. Obviously, we can see what Mark mentioned. There's been a very long history in the sustainability realm of all of these frameworks and the advocacy around this and this voluntary world. But to go from that sort of piece of, oh, now we have an accounting standard, ISSB might take a decade generally to bring out a new standard. This happened in whiplash time for the profession. So I certainly think nature will be a little slower just because it is not as black and white as carbon, to the extent you can call carbon black and white. But I do think it'll still be at a pace that we've not seen before in a non-financial sense over the next few years.
Okay, watch this space. One of the questions that has received several thumbs up is around consistency across standards. While I'm looking, can I just say, Jessica, you are remarkable at multitasking. You've seem to have single-handedly answered nearly every question that's been put forward. So really
Sorry.
No, it's brilliant. I can only do so many things at once, but thank you so much for contributing your expertise in this field. The question was around, there are many standards. There's, GBCA has its requirements to get a rating. NGAS has its, ISC has another one. Mark, perhaps you, with the oversight perspective, what comment do you make that if, a business is trying to do its business, not be a reporting specialist, and yet, one client is going for a GBCA rating, one client is going for an ISC rating, someone else needs NGAS data. That's pretty messy. What would you say?
Having this discussion regularly at the moment with clients. I've got another one tomorrow morning. My recommendation generally is look at the basis of preparation. I know there was reference to basis of preparation earlier on, but really a clear document which says how you're pulling together, whether it's your disclosure in general, whether it's around carbon, it could be on the climate risk side, but identify how you are addressing that, how does it align with the standards, and then what I'd personally recommend is how does it then feed off all of those other standards. And you're really trying to say no one wants to be doing things 2 or 3 times separately, or doing it for one standard and then find it doesn't work for another. I think this is a really important moment in time to look at what other various standards are being reported to, and know that really there is a compliance standard. So that's where I'd be starting, is working on what's required under that compliance standard, and then look at how all others can feed into that. And ideally, just making sure that you're not doubling up. So really important conversation to have. And that base preparation document, that's going to be essential when we get around to assurance, when organisations are working their way through limited and then reasonable assurance. Having that basis of preparation document in place, I think will be essential. So, it might take a little bit of effort to get done, but I'd certainly be encouraging organisations to probably do that sooner rather than later, and just be confident that they're not going to be doubling up and doing some work to find out that it wasn't required or they've done double ups.
Beauty, thank you. Hey, Darryl, a couple of questions and something I'd like to ask you. The first question is, how has supply chain been responding to your request for reporting inputs? And the second one is, and obviously impact is core to why we're having this conversation and why MECLA exists, why you guys have chosen your professional paths. Does a company that comes to you with a better answer have more chance of winning the contract than one that just has a compliant answer? Sorry, they should both be compliant, but one's ticking the box saying, here's the data, and the other's ticking the box saying, here's the data, and by the way, it's better than the benchmark, or it's 10% better than it was last year. Is it just compliance, or is it a performance evaluation criteria?
Yes, it is a performance evaluation criteria, but it's fair to say that it's it's a differentiator, right? So if someone comes and they have that in addition and to ticking the other boxes, then it could be obviously a point of difference that could win them the opportunity. So I think, that's really the approach. And sorry, the first part of the question, Hudson, was
how have suppliers been responding to you?
Yes.
You guys are big and say, well, we need this, and I think some smaller players might say, oh gosh, okay, if they don't do it, they might fold, or if they do it, it might cost them a lot of money. You've got ambitious goals, but have the money to resource that. What's the response been?
Yeah, look, I think, like I said before, we've been a little bit softly in the approach, sort of recognising that. I think some of the stuff that Jessica mentioned earlier sort of resonated with me. I don't think it's necessarily EPDs across the board. I think we've got to balance that, with some pragmatic approaches. But again, we need to make sure it's grounded in some, product category rules, or to ensure that we've got that kind of consistency. But I think in terms of the response, we've actually had a lot of suppliers coming to us going, we've got this, are you interested? So it's kind of almost been the opposite, in terms of not us sort of requesting, but more people offering up what they've got and being really open and willing to share with us what their journey looks like and how they can start to try and provide product that will meet, where we need to be in 5, 10 plus years. So it's been great. It's more a case of us remaining focused around, like, how do we prioritize some of that? And because obviously on our side as well, we're constrained in terms of resourcing and ability to respond to that. So how do we make sure that we're, leveraging the best from our supply chain and also not wasting people's time in the interim?
Okay, here's a question, a very practical question from the Q&A, and that is, a supplier sold you something based on its EPD. How do you know that that's actually what's being delivered on site? A question first for you, Darryl, and then I'd love to see what the accountant has to say about that with your hat on, Jessica. Darryl first.
Lots of schedules and tracking. Again, another opportunity for technology to support. We've had some forays into, scanning QR codes, the receipt of product and material to verify. But having
are we talking material passports there, that type of thing?
The start of that, exactly. So I think there's, that's still got a little way to run. And I think even, looking at, does blockchain technology have a role here? And that could, obviously solve a number of problems or issues around modern slavery, provenance, as well as the carbon emissions associated with the product as well. But I think that we're starting to get that. But traditionally, it's actually schedules, ticking off on the schedule. This is what's been delivered. Here's the monthly claim for what's been delivered, signing it off. Have you got the evidence confirming that we've received what we ordered?
Yeah.
And where's the, by the way, we need this document. Has it got the relevant EPD or other?
Is it up to date?
Bona fides, quality information, fire rating certificates. The list goes on. Yeah.
Jessica, so that's the contractor's view. How would you add to that from an accounting point of view?
Yeah, I think it's, I always try and look at this as like what happens now for other things and how do you slot this in as that additional, like we always say, so carbon accounting needs to become an extension of financial accounting, checking if we're in this world of EOPs, that is something that probably someone in the warehouse, in the procurement team is doing as part of their standard role, just like they would check 3 or 4 other considerations. So I always try to not have these things feel like, this whole new world's coming in to check something, because in other areas or other industries, we often have new compliance requirements or maybe just new business or commercial expectations around contracts. And we simply upskill the people that are at the coalface of those jobs that are going through their normal workflow and their normal process and saying, hey, here's a new consideration for you. And I know when I have been managing purchasing teams in mining, it's making sure every pallet's in, it's scanned to the purchase order, it's all sitting in your SAPs or your ERPs. Goodness knows that even in a normal world, there's things that are far from perfect that go on in that space. So again, sort of that fear, I think, when we start talking about anything to do with sustainability coming into normal jobs to be done, it can just feel so overwhelming. But actually, we deal with the problems right now. We check off different requirements right now. Use the teams, upskill them in a new area, make sure that the ERP systems are capturing that data so you have a source of truth, and make life easy for yourself when it comes to audit time. I would say that is essentially easier said than done, but I'd say that's the normal path.
Beauty, thank you. There's lots of recognition of your multitasking, by the way, in the chat, Jessica. So kudos to you. A question here: could the embodied carbon harmonisation and optimisation scheme proposed in the US in October, could that be applicable for a data exchange in Australia? Is anybody across that to answer the question?
I can't profess to be across it, but obviously we've had some involvement with the WBCSD, World Business Council for Sustainable Development, around the pre-packed initiative, which sounds similarly aligned, but yeah, without knowing the detail.
Okay.
So they effectively set up an exchange for the agricultural sector, automotive sector, and now doing some work to look at whether there's an opportunity in the property and construction sector.
Okay. Another question's come through for you, Darryl, but I'd be keen to hear what the other panelists have to say as well, and that is the observation that companies like yours will ask for EPDs and positions on Green Star compliance on modern slavery, but the question saying, look, some people just refuse to have the information or have the data up the supply chain. How do you respond? How do you start to get the data when you've got recalcitrant parts of the value chain, noting that these hugely fragmented supply chains?
Yeah, I think a couple of approaches. Obviously, for us, it's how do you provide that level of education and support. Examples in terms of us working with, facade suppliers around low embodied carbon aluminium. Like, how do we, there's a large journey we went on with a number of facade subcontractors on building their understanding of embodied carbon and carbon literacy generally. So I think there's that, but there's also third-party standards. So we've obviously our membership with Responsible Steel and driving the agenda around those third-party standards that we can start to rely on that can help to ease some of that checking. So we're sort of asking for the, where's your Responsible Steel certification, knowing that underpinned with that is a commitment and a trajectory to reduce the emissions associated with the product that they're delivering.
Yeah.
Yep.
So I might chip in on that one as well. I think in the past, pre-mandatory reporting, you could probably find a way, if you're a supplier, you could find a way to get around to work with another company who didn't need that information. But if we fast forward now, very soon in the next couple of years, the 6,000 biggest businesses in the country will all be requiring data. And on top of that, Commonwealth agencies, state agencies, and if we flag that local government effectively, we'd expect they're going to go the same way. There won't be too many places to hide if you're not willing and able to provide the data. So I would think that the time will rapidly run out for those who can't. There'd be a question as to what's a reasonable amount of data. And, having come from a small business background years ago myself, I completely appreciate the situation that they'll be in. So it needs to be some reasonable considerations, but you would fully expect that there'll be a requirement that to be part of the supply chain of most businesses, you'll have to be providing the data. It's hard to see it being any other way.
Okay. And where they don't, Jessica, you talked about spend data as in the data pyramid. That's the lowest, lowest level of granularity. I guess that becomes the default.
Yeah, absolutely. I think there's always, it's unfortunate that obviously we have to use spend data, but that is a starting point. That can still be where people, that realistically is the starting point and where people are at. But I think, what we're sort of seeing with companies is we're just doing quite a large case study at the moment that we're actually filming with Optus, who have net zero targets on Scope 3, for example. And a lot of companies are similar, where they're saying, what do you just walk everything back unless you can start getting access to this supplier specific data? What do you do? It becomes this like governance and risk issue if we kind of know that year on year we make absolutely no progress in this space. Where do we acknowledge that we're not going to be able to credibly track that? And what they're doing, and I think which we've sort of spoke to, is just being really upfront with the suppliers and saying, this is the data I need. It can be spend-based if that's where you need to start, but this is the information we require. This is the time frame for doing it. And yes, we are going to have to bring in contractual frameworks around this, because the only alternative is to sit there as a board and say, well, SBTI, whatever net zero target version we may have set. There comes a point where the responsible thing to do for the market, if you are communicating to the market that you have this target, that is in many cases, I think, putting a legal hat on, I think a lot of the time you could reasonably say that a portion of that is to appeal to your own investors and customers to say that you're on that track. And so if all those things are true, and you are publicly talking about this, but you are not putting in the effort to engage those suppliers and put in requirements to collect that, that might be fine, but we have to be very transparent and acknowledge where that line is then being crossed to knowingly accepting that we're not going to be able to credibly track that. And I think that, like we just talked about, what Darryl spoke about, capacity building through the supply chain is the key piece at the beginning of that.
Yeah. And the stick that Mark mentioned is there's not really anywhere to hide in the near future. So yeah, get on with it. Do you know, Mark, in your opening, you said everybody has a point in their career where they kind of remember where they were when such and such happened. In 2000, as a young management consultant, I was working with companies getting ready for the GST, and it was, oh my God, it's the end of the world, and it's the whole accounting system's changed, and now it's just 1/11 of everything, and you get on with it. So I think we've been there, we've seen systems change, and it can happen. Ironically, at the end of that, the company I was working for collapsed, and I remember asking a senior partner in one of the big 4 remaining companies, hey, can I come and work for you and help on building a sustainability practice? Because I think that's going to be really big in the future. And he said, oh, young man, there is no business case for big business to work on sustainability. I hope that bloke's retired now, but it did make me think that 20 years that you had in your timeline, Mark, so much has been done in that. And it's just wonderful to see mainstream accounting, finance, C-suite, all starting to have to get their heads around this if they haven't already. And for fiduciary responsibility to be underpinning all of that, it's fantastic. Hey, we're coming to the end. Can I ask each of you to answer this? What is the top thing you suggest to members of the construction, the infrastructure value chain to get the house in order for looking at mandatory reporting? What's the top thing that you're advising? Mark, can we start with you?
Yeah, I'll go for one thing that's a part of 2 things connected. So one is know when the timing is around your scope 1, 2, and 3 reporting. So know when that's actually going to come through. But then linked to that is think, what are the timeframes I'm working with to get my data systems and governance in place? Because at the end of the day, that's what you're going to need to be able to confidently report on.
Terrific. Thank you. Monique, can I ask you, what are you saying to ISK members and to the broader audience?
Yeah, look, if you're not already on it, then now is the time. Yesterday was better. Identify the people in your organization that contribute to that. Reporting used to be a financial function, and it probably will be in the future as well, but it includes many more people or departments within the organization. So yeah, get ready to understand where the data comes from.
Terrific. Darryl, what would you advise?
I think if you haven't already, start with some scenario planning and look at where your risks and opportunities are, and then the key indicators that you'll need to be tracking and setting up as a business, and sort of embedding, I guess, within your financial accounts and other parts of the business.
Great. And Jessica, you'd probably just like them to give you a call, but what do you advise?
Yeah, I agree with Darryl on the broader piece of the scenario planning, but in our lane of, oh gosh, we're going to have to start disclosing carbon accounting under standards, I would say start the handball to the finance team. They'll say they're probably too busy and they don't know anything about this, and it'll be, the typical thing whenever you try and give someone something new. But I think that process of getting their head in the game on this will relieve the people that actually do have a good amount of context on sustainability and strategy, get them doing the boring level of granular accounting and reporting for the rest of eternity into the annual reports, and then start having that base where the sustainability experts in the company can start leveraging that data for better, more influential business cases with the board, the stuff that really moves the needle. So yeah, I would start the handball and bring them along on this journey.
Fantastic. Hey, to our fantastic panelists for your multi-skilling, your breadth of expertise, but also your generosity in preparing for this and being willing to ask questions off the cuff, questions from the Q&A. This is what MECLA is all about, and I really appreciate the time that you've taken to do this. Mark Siebentritt from Edge, thank you. Darryl Stuckey from Lendlease, thank you. Jessica Richmond, Sumday, really glad I saw you at a previous event and look forward to picking your brains again in the future. If you're ever up here on the mainland, I know you're dialing in from Tasmania today, but you're a welcome friend of MECLA's. Thank you for that.
Thank you.
Monique from ISC, Infrastructure Sustainability Council, really appreciate your contribution and that bigger picture of the big project stuff. Now, look, MECLA's still got quite a lot. The year is fast running out, but MECLA's busy. On the 5th of December, that's today. On the 10th of December, we're specifying low carbon clay, cement, bricks, and roof tiles and piping. Quite specific stuff from one of our working group 5D, which is the construction materials and assemblies. So very practical stuff. Really keen for anybody who's working with those materials to look at what does a specification, what does that look like? And then in partnership with the Smart Creek for CRC, defining embodied carbon on the 12th of December. Thank you, everybody. As always, there's a lot that goes on behind the scenes. Alexi Barnstone has stepped out of another function to help make this work. He's from Climate Kick, and his colleague, Kati Vahayan, also from Climate Kick, do so much to keep our secretariat moving. And always a huge thank you to the commitment and drive from Monica Richter from WWF. It's fantastic having this many people this engaged in something that isn't just compliance. This is about material benefit and improvement and getting onto a Paris-aligned trajectory to reduce our emissions, which you know is so important. Thank you, everybody, for your time today. Thank you to our speakers, and I look forward to seeing you again in another MECLA event soon. Thanks, everybody. Bye-bye.